do so, and the lenders are not willing to kind of extend these contracts they have, they might simply go bankrupt. So this is why we do this. So it has a purpose. It's not just to make things more complicated for you. Okay, now layout. I mean, we had this already in some form, but here you get an example of how this usually looks. So we start with the assets, non-current assets, and then we have here these three elements, and then we have this partial sum, this 294. What you also see, it's not 3 zeros after every number, but it says in thousand above. It can also say in million if it's a very big company. So be a little careful and watch out for these things, because it gives you a clear clue, hint about the size of the company. Very often it's also in 100,000s. That's also something that can happen. So look out for these things. Then current assets, inventories, trade receivable, cash. That's usually the current things. So sums up to 53, and then we have the total assets, this 294 plus 347. I think it should be clear, total assets is really non-current assets, or the sum of non-current assets plus the sum of current assets. So be a little careful if you do the sum thing in Excel. Do not take the sum overall, because then you basically double the assets. If you take the lines, property, plant and equipment, motor vans plus the sum, then you're too high, right? So just be a little careful with the calculations there. And what you also see is kind of within these parts, non-current and current, some sorting depending on the liquidity. So it's assumed that property cannot be sold very quick, that this usually takes quite some time, and that's why we have it in the very beginning, then plant and equipment, and at least a car, a motor van, in comparison to property, plant and equipment, it should be clear that you can sell that faster. That's why we have this order. And then current assets, kind of the same, inventories, trade receivable, cash. Cash at bank, there, if you might also use some other textbooks to have some additional exercises, because in the end it's all the same. It might be the case that there's a differentiation between some bank account cash or really cash, so bills and then coins. Usually it's all the same. We usually consider it all the same. However, you might stumble over something like this, and then the content is really the last line there. You have a question? Who can help the colleague of yours? He's asking, where does the equity number come from? It's basically the difference between the total assets and the liabilities. So let's take this equity back and really start with the liabilities. So we have these two forms of liabilities, non-current, current, and non-current, long-term borrowings. So, the things the finance people care about, making how to finance an investment. Well, we go to bank X instead of bank Y and lend this money because we get better interest rates, right? So this is something like this, long-term borrowing for investments for different projects, 50. And then current liabilities. Here we have this trade payables. This is the common thing if you have some trade business. Other things, you said it, right? Bank overdraft. If you get into the minus on your bank account, this is also something current. But it can also be some short-term lending. So I do not know, but as a private person, I sometimes get these offers with ridiculously high interest rates to finance something like a holiday trip or so, right? And usually you have to pay back within half a year or so, and this would also classify as a current liability, not some long-term borrow. Okay, so, but in sum, well, these liabilities are 87. Yeah? And now, your question was, where does the equity come from? How do we calculate this? And your colleague gave you the answer. It's the difference between the total assets and the liabilities. And if you think back about this idea of claims over this asset, this makes sense, right? So the firm consists of all these assets, and then we have this 87 liabilities where someone else who's not the owner have a claim on, and on the rest, the owners have a claim, and that's the 260. Yeah? So this 260 is really the difference between this 347 and the sum of liabilities 87. Yeah? Okay. And that's basically the standard layout we use in this course, and that is mainly used. For completion, there's this alternative layout. What you see is asset side, that's the same, but then it changes a little bit, and maybe there you can better see where the equity comes from if you look at the lower part. Because here it starts with the liabilities, and they're stated as negative numbers. Yeah? And then basically the total assets are added, or these negative numbers are added to the total assets. So in the end, these liabilities are subtracted, and you end up with the so-called net assets. So the assets the owners have a claim on which equal equity. Yeah? So there you might see it a little bit clearer where these 260 come from, whereas the calculation is the same. It's just the exposition is different. Okay, so if you stumble over the term net assets, it's basically equity. Yeah? So total assets minus liability, what is equity? Good. Just a reminder how this works and what's equal to what. Now about accounting conventions, and this is important, so you should keep them in mind when you consider financial statements and when you want to set them up yourself given certain transactions. So first convention, business entity convention. So that means the business itself is considered as a single entity where the owners are considered as just those that provided the funds, so they are not part of the firm themselves. I think we discussed this already last week and then maybe the week before that. Yeah? So the idea is really to keep the owners' personal funds and the business funds separated. And of course there are business firms where this is not really necessary. So this Paul guy, for example. I mean, he was running this business, he was selling this paper, and he was the only one financing this firm. So there he was the only owner. However, firms that have to publish financial statements to send these things to the public are usually limited liability firms. Have you heard of that expression before? What this is, a limited liability entity? Can you explain? Yes? So it's a separation between ownership and the firm, but what's limited? What liability is limited? What does this mean? That's
so the assets of the CEOs, like they're all
exactly. So if the firm goes bankrupt, has a lot of debt, the creditors cannot go to the manager running this firm and say, well, sell your house, sell your car, and give us our money back. Yeah? So this is the limitation we have. And that's also the reason why we have this very strict rule in order to prevent managers kind of doing things they profit off and in the end let, well, the owners stand there having nothing left. Yeah? There is a chapter on this limited liability companies in the textbook. I think it's chapter 4. I will not test you on this, but it might help you understand a few things better. So I recommend reading it. It's not mandatory, yeah? But that's basically the idea. Then we have the historic cost convention. So as a starting point, of course, there are a lot of exceptions. We use historic costs in order when we want to measure, yeah, the amount we want to put on the balance sheet, right? So the reason is actually it minimizes this measurement problem. Of course, you can say, well, this property is not worth what I've paid 20 years ago. Probably it's much more worth. Yeah? But what would happen if you now, instead of, let's say, you paid 10 million 10 years ago and now it's 20 million worth? What would happen in your balance sheet, in your financial statement, if you write this up? If you, instead of the 10 million worth, write 20 million? It's an overstatement, so your equity needs to go up because there's nothing to cancel this out. And then addressees, not looking very closely, might think, yeah, well, the firm made a lot of profit. But have they made profit yet? No, they didn't sell this property, they still have it. Yeah? And then, yeah, things might start to roll. I mean, if it's considered as profit, even though it's not sold, the firm could start paying out dividends. Yeah? So bringing money out of the firm, and in the end it might happen that they cannot sell this property for this 20 million, but the dividend was paid out already. Yeah? So you see the issue here, and that's why the historic cost convention is kind of the safe rule to apply. Because, well, it's clearly measurable and there's no speculation in it. Of course, it comes at the cost of, well, maybe not that precise information because the assets might be worth more. And these, again, are things that are very, very specifically regulated in financial standards, what you're allowed to do and what not, when you can apply so-called fair values to some assets and when you have to stick to historical costs. In this course, it's mainly historical costs we do. However, I think there are some exercises and examples where we have such re-evaluations of assets with a write-up, just to show you the mechanics of what's going on here. Okay. Yeah.
What if the historic value of the company is actually more than it's worth?
Then you have to write it down. So that's prudence convention. So you always have to be careful. So it's an asymmetric, these things are actually handled asymmetric. Yeah? So caution should be experienced when preparing financial statements. Bad news are reported earlier than good news, if good news are reported at all. And again, the financial standards usually define what can be done. So there are, for example, rules. If you realize that an asset is suddenly worth less, you have to write it down immediately. If the value recovers and even goes above the initial historical cost, you might write it up again, but only to the historical cost limit. Yeah? So you can reverse this writing down, but only to a certain point and not above this point, and this point is usually defined by the historical cost. Yeah? So asymmetric reporting here. And again, the idea is, well, here in this case, kind of protecting the lenders from, firm managers and firm owners' incentives. Because, well, if some gains are not realized, they might take out the money of the firm, and then they might not be able to pay back their liabilities. So it's really something that comes from the, I would say, it's a very continental European thing to protect the lenders from the owners, whereas if you look in more English or US founded standards, they were always way more towards, well, the information and allowed for more fair value assessments. And also the international financial accounting standards kind of go into this fair value direction instead of historical cost. But here in Europe, the traditional thing was to be very prudent and very careful. And that's what we have in this upper point here. And of course, also in the IFRS or US GAAP, there are still elements in there. Then, going concern convention, so if we do these things, we usually assume that the firm will go on and will survive the next year. Otherwise, there needs to be some information to the addressees of such statements that this might not be necessarily the case. So, I mean, this is now a little ahead, but if you might take some auditing course at some time, you might talk about the so-called going concern opinions. So if the auditor, so the guy that kind of gives assurance over these financial statements that everything is set up correct, thinks that the firm will not survive the next year, they kind of have to notify the addressees. So even though the financial statement might be set up in accordance with all rules, this auditor needs to notify about issues here that the firm might not survive as an additional information. However, usually if there's no such notification, it's assumed that the firm will survive and everything goes on as expected. And then the dual aspect convention, that's, I think, kind of the beauty at the core of accounting is that each transaction has at least, it's not exactly two, but it's at least two aspects which affect the statement of financial position. And we saw this when we looked at this transaction. We never had the case where we only changed one line, but always two things changed, and depending on what these two things were, well, there was profit or not. So that's basically, I would say, the core of accounting, and we do some more exercises on this. Okay. And that's what I kind of want to do now with you. I mean, I'm not through with the slides, but I would say just, for the sake of time, go over it, and you will also get an reading assignment with a few questions, but I think we will get along with the rest. I think it's more valuable to start this exercise and to get an idea of this. Where was it? Dual aspect convention. Okay, but before we do this, we do another exercise where we kind of deal with this with a standard layout. Okay, so this is from the textbook. All things are from the textbook, but I want to do them in properly with you, so you know how these things work and can do all the other exercises yourself. Okay, so this is this self-assessment question from the textbook. What you have here is basically a lot of items that usually show up on the balance sheet, statement of financial position, but they are not ordered properly. So first requirement is to sort these things out. Then it's a little bit about interpretation. What can you learn from such a statement of financial position? And the last thing is then about this duality, where we basically have let me see. Yeah, a re-evaluation of some assets, as we talked about a few minutes ago. Okay, so I just copied this basically. So this is everything we have. So first thing you should do is you can quickly go over it and tell me if there are elements that should not end up in the balance sheet. Pardon? Non-current assets? Equipment? Where's equipment? Plant and equipment. No, why should this not be in the balance sheet? No, it's about those that should not be. Sorry. So most of them will end up there, but a few not. Profit, exactly. Profit is not part of the balance sheet. I mean, I said in the first part of the lecture today, it might show up as part of equity, but we don't put it there specifically. So profit is out. Something else out? Drawings, exactly. This is also not part of the balance sheet, the statement of financial position. And there's one more thing that you need to look closely. So these numbers are all from September 30th. There's one odd number. Last year's equity, exactly. We can use this as a point of reference, yeah? But it should not show up in this year's balance sheet. Okay, so let's maybe just mark them so they are out, these two. Okay, then if I want to set up a statement of financial position, with what do I start? So I'm talking about the headlines now, not the first item. Assets. And then if there are non-current assets, there are probably current assets as well. Okay, then let's maybe start with these things. What do I have to put where? Plant and equity idea. Let me just do this like this. Where should I put plant and equity? Non-current. What else? Property. Can you help me sorting this a bit? Is this okay? Up, exactly. Property goes up. So it should be like this. Further things? Where is it here? Are we done with non-current? Fixtures and fittings, exactly. That's something we should squeeze in. And I think it's also in line with the textbook, I would squeeze it in between the vehicles and plant, so it's something that is attached to the plant, right? And I think that's about it. So we can in the first step do the sum here. It sometimes helps with, well, reading these whole things if you put in maybe something like this, so these fatted lines that you see where the sum is. So all I did now is I sorted, or you helped me sort these non-current assets to the right, and then I take the sum to have this, yeah, the sum of the non-current assets. Okay, if there's nothing missing, we can go on. Current assets? Is there a question? So it's important that you follow what I do, but you got the numbers in the book. Yeah? It's really the exact example from the book, but you should be aware where these numbers come from, because later you will just have the number. So it's more important to observe than to copy. Fixtures and fittings, why should it be a loss? I don't... You get... Ah, okay. Yeah, but it helps you kind of running your business. I mean, what's an example for fixtures? Maybe the sink and the toilet in the bathroom that is plunged to the wall. But if you would not have this, your workers would have to go out every time to some public place to do what they have to do, and this will cost the money, the firm money, because then they don't work. So it's not directly linked to producing something, but well, let's take BI as an example. I mean, I'm producing revenue now because I'm teaching you, but there's a lot of administration there, they don't teach you. But anyhow, they work, so your studies go neatly, yeah, and they need an office to sit in, but this does not provide teaching to you in any way. However, it's still necessary to get the whole thing running, and that's the same with the fixtures and fittings. And I mean, what is important is that it's there for some time. I mean, what you might have in mind, if it's really small little things, that could be treated just as an expense. For example, if BI buys copy paper and not so much, you would not put it on the balance sheet, you would just say it's an expense. Yeah? And running expense, which we do in chapter 3, yeah, which decreases income but does not show up here. But here these things, they are, well, significant and elemental. It's not just something very tiny. Then you would be right, it's an expense, why does it show up? But here it's really, well, office furniture and things that are just needed to do our jobs. Yeah? If I wouldn't have a second screen, I could not prepare well. That's what okay? Okay, but now let's go on with the current assets. Yeah. I heard inventory, that's correct in any case, and then trade receivable and cash. Okay, and how should I sort this? Next, trade receivables. No, that's payable. Here it is. So the receivables and the cash. Yeah. So you see, even the book is not consistent. Sometimes it's cash at bank, sometimes it's cash, sometimes it's cash in hand, but it's all the same. Yeah? Just don't get confused with these things. And I think we're good, right? Nothing left. So I can again take the sum, and we got this. Okay.
So is it standard to list things with
Yes. Yes.
the
Yeah.
both current and
Yes. So the question was whether it's standard to list from, well, least liquid to most liquid, and that's the case. Yeah. Also within these two blocks, non-current and current. Yeah. And I mean, of course, it's not so clear. Inventories, trade receivable, of course, it depends on the contract you have with your suppliers, where you get the money earlier, but this is kind of the common thing, but nobody will, kind of pick on you if you switch trade receivables and inventory, but cash should usually be the bottom line here. Okay, and then we have total assets, and that's basically the sum of these two things. And as I said, be a little careful here, so don't take the whole sum, because then you will have, well, everything twice if you take partial sums and then sum it up. So don't do this. Okay, then next block. Equity and liabilities. So we use the standard form. So what's the first item here? Equity. Okay, I leave this open for now. Then next block. What type of liabilities? Non-current. Okay, what's in there? Yeah, it's not much differentiation. But also here, you usually apply this ordering. So it might be the case that you have to pay the money back in 10 years or in 2 years. Everything is non-current, but, well, the 10-year loan stands above the 2-year loan, right? So also here this is applied, this ordering. Okay, as we only have this one issue, there's no, or this one item, it does not make sense to take a partial sum here. And then we got the current liabilities. So there's not much left. What we have here. So this all goes down. Here it's a little more, how to sort. I couldn't tell what's right and wrong. This is more of a personal taste that I would put the short-term borrowings above the trades payable. Yeah? But again, we have something where we should have a sum, because we have these two elements. Okay. So what we have is this non-current liabilities and this current liabilities. And now, what about the equity? How can I calculate the equity? Yeah. assets minus liability, exactly. And if we have it set up like this, we need to be a little careful because we have two types of liability. So it's the total assets minus, and then basically the non-current liabilities plus the current liabilities, and that's it. 120,500 equity. Yeah? So you see, applying this equation leads to equity. However, here we have something in yellow left. Could that help us also to calculate the equity and maybe to double check on whether we did some mistake or not? How can this be used? Exactly. So it's equity plus profit minus drawings. So instead of calculating this in that way, you could also say, well, starting equity plus profit. And this would basically be this equation I showed you this morning on one slide, this extended accounting equation, right? Where we have this works without injection or withdrawals of additional money. However, you see, it does not pan out here because something else was going on. And this is how you said correctly. We also have to subtract this withdrawal because money was taken out of the firm by the owner, and we need to calculate this in too. And you see, if you use these three pieces of information, we get the same result and we did everything correctly. Yeah? Okay, very good. Yeah, I think we're done for today. Tomorrow we will also do one more exercise with with 7 or 8 transactions. So similar to what we did this morning, and I'll show you I think convenient way how to deal with this and how to access this. Okay, tomorrow.
No, that's not what you're supposed to take equity as one. Write down equity, blah blah blah, 117.5 thousand.
Man kan reste etter ut og det kan man se oppstart.
And you replace equity
Jeg får til meg.
that.
Jeg får til meg. Kan en lei? Jeg vet kan det. Jeg tror det får folk for det.